Hello, everybody. This is a presentation I created in relation to explaining the financial problems and to better understand the economy and money. Um, so the financial problems today that are triggered by the crisis with the virus, right? It's mass unemployment. Uh, Companies are struggling to survive, as you know, as demand reduces. Extreme financial difficulties are being faced by the labor class, and you're seeing this as well with all the poorer people struggling um, to survive. And with the current stimulus package by the government, they're trying to do their best, but is it really enough? So we're going to try and touch on some opportunities. So this video is an attempt to explain the problems in a simple manner and to also suggest practical solutions to address the problems with the intent of spreading the word to align government actions possibly for better outcomes. So now to understand the solution, we have to understand the problem first, right? We are going to touch on understanding GDP or the gross domestic product. We're going to touch on understanding money supply and how exactly money is created in the system. We're going to touch on ideas to help the poor. And finally, we're going to touch on how modern bank lending can increase GDP, jobs, and income. So that's the goal. So, what is GDP? So, a transaction which is buying or selling ultimately adds up or to the total GDP in an economy, right? So, and this spending is actually cash or credit borrowed by an individual or a business, which is then spent for the purchase of goods, services, or financial assets. And we're going to get into more detail, right? So, the sum of the total spending makes up the GDP of an economy or a country. Now, the price of anything is the total spending for that particular thing divided by the total quantity produced, right? So the total spending, which is the cash and the credit that is being spent in the economy, divided by the total quantity of goods, services, and financial assets that are goods and services actually results in the price, right? And we're going to look at this in more detail because when spending goes up, if the quantity of products and services not increased, then you're going to see an increase in price, which is inflation, and that's not very good. If spending goes down, which is what we are experiencing today, then there's a risk of deflation where the prices go down, and that's not very good as well. So ideally, you want to increase spending with corresponding increase in products and services, and that is what is best for the economy to keep the price steady as well. So now, the one person's spending is another person's income. So this is important to understand because irrespective of that spending being cash or credit, it results in income for somebody else and some other individual or business. And that's a small unit of what contributes to the economy, right? It's important to understand that when you look at the total money supply or the total spending, 3% of that is actually money created by the government. 7% of that is money created through credit or through bank loans. That is the vast majority of what's contributing to the spending. So this is important to understand. Now, banks actually create money out of nothing when they make loans. So let's understand that a little better, right? So what's happening is when an individual or a borrower is approved for a loan, the bank creates a deposit in the name of the borrower, and the borrower gets money to spend, right? So that loan now becomes money that the borrower can spend. Now, once the borrower repays the loan, this money created then disappears. Most money available to spend in the economy is created by banks, and this is very important to understand. Government created cash and bank created credit drives all spending. So, to understand this better, let's visualize the spending driven by the government cash as this inner circle, and the spending driven by bank credit as this outer circle. The sum of these two spending scenarios gives you the total GDP of the economy, right? So, this is a good visualization of how to understand the total spending and what contributes to the total GDP. Now, in tough economic times, when spending goes down, what you see is now there's a gap, right? You have the products and services that were created, and when the spending goes down, there's a drop in demand, And that's not good because it reduces the sales and income for a lot of companies and businesses, and there are job losses and such, right? So that's the problem. But this could also be an opportunity where, when you look at opportunities to help the poor, imagine a third circle that we can call universal basic income that fills in that gap. And what's happening here is, uh, just like government created money in the center, government could actually distribute a universal basic income to every adult citizen about 18 years of age, for example, that could actually plug in that gap and almost, have the current crisis as an opportunity to improve the situation for the poor, but actually also help the economy. So this is just a visualization of how that can work. Now, let's also look at modern bank lending and how that can help grow the GDP, create jobs, and raise income. So here we're talking about the three types of loans that banks typically make. The first loan is a consumer lending loan, which is personal loans, credit cards, and such. The second type of loan is loans given to businesses or individuals to purchase financial assets. And the third type of loan is loans given as working capital for businesses. Now, a consumer lending loan results in spending and creates demand, but if it's not done carefully, you're going to increase spending without an increase in the availability of goods and services. You could potentially increase the prices, right? And inflation. That's not very good. But if you do it in moderation, that's not too bad. Loans given for purchase of financial assets, that is a potential problem, because when a loan is given for the purchase of existing assets like existing homes, buildings, stocks, and shares, this inflates the prices of these assets, but don't necessarily boost the GDP or create jobs. It is just the title of an asset moving from one entity to another entity. So loans for the purchase of financial assets is a second type of loan. And the last type of loan is loans given as working capital for businesses to manage their cash flow. Now, remember, working capital for businesses results in the production of goods and services. So, when money is created for working capital for businesses in the form of these types of loans, you're increasing the spending in the economy, but you're correspondingly increasing the goods and services available in the economy, and therefore the prices are not going to rise, right? And that's a good thing. So these are the three types of loans. So what is the most productive type of loan for our purpose, right? Obviously, it is the loans given for the working capital of businesses. And that's what really drives the economy, creates jobs, raises incomes, and such. So to actually apply this modern bank lending um, options, what if the Reserve Bank mandated different interest rates for each loan type? So what if a consumer lending loan had an interest rate of 8% in India, and financial assets, because those are not ideal, had an interest rate of 10%? And what if the working capital for businesses was just 1%, right? Because now we're going to stimulate the creation of products and services. And if you also encourage demand by allowing for very low cost or low interest rate loans as a promotional offer for new homes, and that's important to understand, new constructed homes and buildings, because that kind of spending is creating a new home, which is an addition to the GDP, and it's not an existing home, right? That's very good. So that's the potential solution as well to help with the current situation, to grow GDP, create jobs, and raise income. Thank you very much.